webcast is now starting. All attendees are in listen-only mode.
Okay, thank you to Dinakar for saying no audio. I started the webinar and didn't push the. I have two mute buttons and I unmuted one of them and not the other one. So thank you for that. I've been talking for 3 minutes that nobody heard, so I'll try to recap that quickly. Yeah, it's our members only workshop. I'm Bobby Rains. We had a members only workshop last week to talk about the new website. You can still find the recording of that on the website. Any questions you have about the new website, we're happy to answer them this time through. Anything else you want to talk about? Also, we're happy to get to. And thank you to everyone for the feedback, questions, bug reports, all of that. We appreciate it. We're working on it. If we haven't gotten to your bug yet, we will. If you have a bug you haven't reported yet, let us know. And thank you for both the patience and the feedback that we've gotten from everybody. And any other questions you have, put them in the question box. All right, so this is our regular 2-year candles. I grabbed the image here a little bit early. The market managed to turn around after the Fed meeting, but I had already pulled the slide at that point. So that's why that last candle there is red when it probably should be green. But that is, yeah, here we go. We're at new highs, closed at new highs today, which is nice. We're still waiting for the fundamentals a little bit. There's also a bit of a gap here that, I don't know, may or may not be consequential. The saying in technical analysis circles is gaps like to be filled, but not all gaps ever get filled. So then there's always the, except for when they don't. So we'll see. It is something to keep an eye on, but it may or may not end up being particularly consequential going forward. All right, this chart I put together out of this morning's GDP report. You got the blue line there is GDP. The consumer spending, which is, I sort of combined what they call residential fixed investment and personal consumption expenditures. I combined those to get the orange line there into what I'm calling the consumer component, and then the business fixed investment, or as the Bureau of whichever bureau it is, labor statistics, maybe somebody in the Commerce Department calls it a non-residential fixed investment, which is essentially business investment. That's the red line there. So you can see, and if you follow our portfolios, a theme recently has been that the consumer is strong. Consumer spending has been on the rise and doing well, and so this is actually the change on an annualized basis. So 1.9 was roughly in line with, I think it was 2.0 for the previous quarter. But you can see the consumer has been strengthening for a while, whereas business spending has actually been going down. And yeah, it is the business side of things that has been a drag on GDP. Which if we could get that to turn around, that was one of the sort of promises of the Tax Cuts and Jobs Act was we'll cut taxes for businesses and they'll have more money to invest and the economy will grow. And yeah, that does not seem to be happening. And there are other reasons for that that we'll talk about on the next slide. But generally, that is where the weakness has been, is in business spending. All right, what else is going on? Trade, no one still knows anything. The great phase one of the trade deal is, I still don't know any specifics. Chile today, because they're having some political unrest, canceled the summit where Presidents Trump and Xi were supposed to sign the phase one deal. So if the terms of the deal are still getting worked out and the summit isn't happening, can you sign a deal that maybe exists at a summit that doesn't happen is something we can all try to think about the implications of. Yeah, I don't know. No one knows anything is where that comes back to. The last thing I saw, I guess, Treasury Secretary Mnuchin said something today about it'll take a while to get to China buying 40 or 50 billion in agricultural products, which is roughly double the 20 billion, which was the last number I saw in terms of being in this phase one deal. And 20 billion in agricultural products purchased by China takes us back to where we were before the tariffs started in the first place. So now we're 18 months, 2 years into a trade war, and we're trying to get a deal that gets us back to where we were to begin with. So that's kind of where that is. And that's one of the reasons you're actually seeing less business investment is people are kind of unwilling to invest in a business when they don't know what the outlook for that business is. Right? You're not going to put a lot of investment into a business that would import something if you think there might be tariffs on it. You're not going to put... If you're raising soybeans, you may not buy a big tractor if you're not sure who's going to buy your soybeans. So all those things are sort of reasons that some of that business investment has declined. All right, and yeah, the Fed cut interest rates today by a 1/4 point, which pretty much everybody expected. This quote here is from the Fed statement. Although household spending has been rising at a strong pace, business fixed investment and exports remain weak. That statement came out after I put together my talking points for that GDP slide there. So Jerome is on the same page that I am as far as that goes. The Fed removed the phrase "act as appropriate," which, saying you're going to act as appropriate in that sort of job is always weird because you have to wonder how they were acting before, and then you have to either keep saying it forever or people are going to be like, oh, well, are you going to act inappropriate now? But I think he kind of clarified a little bit in the press conference. Essentially the line was something along the lines of current policy is appropriate, which I assume means the sort of the stock and not the flow, if you will, in terms of current policy as in interest rates are appropriate now, probably not the path of interest rates in terms of cutting every second meeting or something is appropriate. So I think that's how I would interpret that. And then, yeah, the balance sheet stuff didn't really change as far as I could tell. And then, yeah, I mean, the stock market's at new highs. Financial conditions seem to be okay. This generally seems to be about trying to overcome this weird hump we have where inflation is pretty stagnant, wages are pretty stagnant, but otherwise things are pretty good. And so, yeah, the Fed doesn't cut rates when the stock market is at all-time highs particularly often. I forget when the last time was, but it's certainly been a while, and it's not normally the way those things work. And then, yeah, broadly, some of the economic data is softening. The consumer continues to drive things forward, and yeah, it's business investment and exports, things like that have been soft. Government spending tends to be a little bit cyclical, so it's sort of been down this quarter compared to where it was in previous quarters, but a lot of that has to do with like the end of the fiscal year and then restarting, things like that. And then, yeah, I don't know what's going on in Britain. I spent 20 minutes getting ready for this, trying to figure out the difference between honorable and right honorable, and decided that it didn't really matter. No deal Brexit is the sort of worst case. Probably canceling Brexit from an economic perspective is the best case. And then there's a spectrum between those two things, and I don't think anybody knows which one it's going to be. So that's where we are. It's not happening tomorrow in any case. So yeah, that is what I have to say about Brexit. All right, so like I said, we did get a good number of questions ahead of time. So yeah, and I mean you'll see there's some pretty basic like option questions. We got some website questions. We got some, what are you doing in this portfolio questions, and we're happy to have all of those. Hang on a second, let me remove this extraneous box here. All right, that looks a lot better. Okay. So Jason said one topic request for me would be on option collars, especially our new collar spread with First Solar. That's in the covered call portfolio. He's interested to learn how it works, why it's used, and how are the collar dates selected. Yeah, so a collar is basically a covered call that's married to a bought put. And so you end up being capped on the upside, right? If you have a covered call and the stock goes way up, you don't participate in all of that above the strike price of the call you sold. But when you buy a put, you're also capped on the downside. And so yeah, buying puts cuts into the profits from a covered call. Obviously, you sold a call and then you had to use some of that money to buy a put, so you're going to make less that way. And there's a number of ways to do collars. I mean, you could sell a call pretty far out and just offset the cost of the put, and then you're covered, against some emergency situation, and you're relatively unlikely to be assigned on your call. That's one way to do it. That's not really what we're doing here. What we typically do is we use it as a hedge against specific risks. In this case, and in most of the other cases we've ever done it, it's earnings, right? Earnings are a big source of volatility, and if we have a portfolio position that we feel like we need to carry through earnings, sometimes we'll collar it up, and that way, if earnings absolutely are terrible, our loss is capped there. And in terms of how we pick the dates, on the put side, we don't want to buy too much insurance, right? Like, I mean, if I want to insure something for the next week, I'm not going to buy a 6-month insurance policy. I'm insured for the week. So typically we'll look at, it depends on where in the week the company reports. If the company reports Monday, we may look at a put that expires that Friday. If they report on Thursday, I think First Solar reported Thursday of last week, and we bought a put that expires this week, just because sometimes the post-earnings trade, the first reaction is good, and then the second reaction is bad. This case, we kind of had the opposite, where the first reaction was not so good, but then the position has actually gotten better since then. And we'll see. First Solar was down a bit today. It didn't really seem like it was worth the trouble of of selling the put. If the stock goes way down, you can sell the put and keep the position open, or buy back your call for basically nothing and exercise the put and sell the stock. There's a bunch of ways to handle it on the downside in terms of how you do it there. But yeah, we're we'll see what we can get for the put tomorrow. We may sell it, we may just let it expire. It depends on what the value is there. And then, yeah, picking the date on the call. Since the point of the put is basically to get us through earnings without taking on a lot of liability we're not comfortable with, we're fine to pick the call based on cost basis at that point, as we would with any other trade. So we went out to, I think it's November the 22nd, and we basically looked at something where if we're assigned on this call, we still want to be profitable. And so that's where we're at with that. In terms of how we manage that position, it's down further than I probably would like. We may look at buying that call back before the 22nd, just because it's far enough out of the money that there's not much time value there, and then go from there. But earnings was last week, so we've got a couple of months now to look at in terms of trying to sell time value against it. All right, so that's that one. All right, so this one from Ted, he wanted to know how we could give a score of 100 for XNet when there's no fundamental data or analyst coverage, especially since the Chinese coverage, even if they produce fundamental data, that data tends to be questionable. This is a really good question. So overall score we will calculate for any two. We obviously prefer to have three, but any two of short-term technical score, long-term technical score, and fundamental score, we'll put any two of those together to get an overall score. And yeah, so the thing is, right, as Ted mentioned, no analysts cover the stock, and even if they did, right, like Chinese company financial reporting can be pretty suspect. So you're really only left with technical information anyway. And markets are, among other things, a giant system to take thousands, if not millions, of opinions and sort of convert those into a price. So yeah, we're okay with that. And so yeah, we have to make a score with the best available data. And if especially if we don't trust the fundamental data anyway, I'm not sure exactly what the point of scoring it would be. I guess we could come up with another system that scored the reliability of the fundamental data, but you can start to see the rabbit holes that open up from there. Now, if you want stocks that only have a fundamental score, you can go to the stock screener. I'm actually going to do this so you can see what I'm talking about here. All right, so you can go to the stock screener, and under fundamental analysis, find fundamental score. If you put a 0 in for the minimum, it will find every stock that has a fundamental score, full stop. So if the fundamental score is 0, you'll find it, but you won't find anything that has a fundamental score that's null, which means we don't have the data to make a fundamental score. Obviously, if you don't want a fundamental score that's null, my guess is you probably don't want 0. So you can put a higher number in there if you want. But that is a workaround for that sort of problem anyway. All right. And finally, Mike had a couple questions about picking the right call option, sort of time and value for covered calls, and then some other questions about income generating strategies. So the first thing about selling calls is that a shorter call will typically have a higher annualized return. Annualized return is really sort of a fancy way of thinking premium per day, right? So if you could sell a one-day call for a nickel, a 1-week call would probably be somewhere on the order of 20 cents, let's say, adjusted for lots of things, but that's not far off from the relationship. Okay, so right, 1 day is 5 units, 5 days is not 25 units, it's something less than that. And so yeah, shorter calls typically will have a higher return in terms of annualized, meaning if you repeated this thing every period for a year, you get the highest return if you can sell. I think that SPYs have 3 expirations a week now. So yeah, you could get a pretty high return if you wanted to do that every 3 days. The thing about that is those very short period calls are going to have, right, you're going to have to be basically at the money. right? Like selling a call that's very far out of the money at all on a 2-day, right, on a 2-day time horizon, you're basically going to be at the money, which means you're going to get assigned a lot. And so, yes, that ends up taking a lot of managing. Commissions have been lowered to 0 or eliminated. There are some places where there's no trading commission, but there's still like a 60 cent or something per option contract sort of fee. So, yeah, I mean, that potentially takes a lot of managing. You end up with a lot of transaction costs. I mean, your mileage may vary. My general feeling on this, if you're talking about income generating strategies in terms of retirement, and I don't know what Mike did previously, but if you wanted to spend 8 hours a day in front of a computer in exchange for cash, maybe don't retire. I don't know. If you want to trade options and do it all day, that is fine. We're more than happy to help you with that. But I think most people in retirement, and a lot of people who are doing this before they retire or whatever else, don't actually want to be day trading or having to manage positions every day. And so what you want to find is a sweet spot between maximizing your return rate and sort of lowering costs. And by cost there, I mean obviously both the time spent managing this thing and also whatever your transactional costs are. And that's what we tried to do when we wrote the algorithms that pick the trades in the option screener. And that's why you see different stocks have different expiration dates. For stocks where we can get away with it, where we think we're making enough money to make it worthwhile, yeah, absolutely. You'll see, 1 week, 2 week sort of expirations. And for the stuff that's, boring and less volatile, where 1 or 2 week doesn't even make sense to sell that call, it goes out further in time. So that's the basic way of thinking about that. As far as I'm concerned, is how you got to think on how much your time is worth and what your transaction costs are, and then kind of find a strategy from there. And go at it that way. And as far as income generation goes, I mean, there's a couple ways to it. One is to sort of roll a fixed investment, right? So you can put some amount of money into a trade. When that trade closes, you take the profits, and that is your income, and then reinvest that same amount of money again. Obviously, that only really generates steady income if you never have a loss. And so what you end up having to do is you invest some number of X's there and sweep the profits from all of them. And then if you have a loss, hopefully it's basic diversification, right? If you make 10 bets instead of 1 bet, and then if one goes bad, the 9 should have you covered. And then some other strategies are just selling out of the money covered call. We have if you want to find a stock that you like, I don't know, let's just pick a stock here. Coca-Cola, you can go to options here and use the out of the money covered call calculator. And it doesn't really matter your cost basis if you're using the income generation strategy. But if you put it in, it will put together a yield based on your investment. So yeah, we pick a call here that has less than a 30% chance of being assigned, which means that you have a 70% chance of keeping your stock. So that's another thing. And so, you do that per 100 shares. You can even stagger them. If you had 500 shares of Coca-Cola, maybe you do this today and then do it in a month and do it a month after that. And then you don't have, don't necessarily have your whole lot of Coca-Cola shares called away at the same time. And so that's another way to approach that. That has, it turns out, different tax implications, of which I am pretty unqualified to discuss. It also likely has lower cash returns, just because if you're selling calls right at the money, you're going to get a higher premium there. And all things being equal, if all you're collecting is premium, that 30 delta pretty far out of the money covered call that we're selling with the out of the money covered call picker. Again, you're less likely to have your shares called away, but you're going to get less money up front for selling the call because of that. And then you do that. Coca-Cola is not a bad example because you do that on a dividend paying stock, and now you get went away. Yeah, so now you get the almost 3% annualized yield from selling the call, and then also you get whatever Coca-Cola's dividend, which is another 6%. So yeah, if you could roll that strategy a few times a year and then take the dividend on top of that, now you're at, until your shares get called away, a 6% return instead of the 3% on Coca-Cola. So you just sort of doubled the dividend there. So that's another way to handle that. All right. Well, yeah, that is all the questions we got ahead of time. But yeah, any other questions anyone has, I am ready to answer. All right, there's a couple of questions that just popped in. Can we talk about selling puts? Sure. A sold put is sort of functionally the same trade as a covered call. So we got this, the strike prices are different, but that's fine. Yeah, so we have, the two trades here. The classic P&L graph ends up looking pretty much exactly the same in terms of covered call and a sold put. The difference is sold puts don't require you to own 100 shares of stock, which means, especially if you're trading in a margin account, you can sort of lever your positions up there a little bit more because yeah, you can't buy options on margin, but in terms of covering your liability, I think you can do that on margin, so that works out well there. But yeah, basically what happens is you sell the put. In this case, you're going to sell, say, a 53 put, and anything above 53, the put goes away. You keep the 84 cents you got in this case from selling it. Right, no problem. On the downside, selling a put is an agreement to buy the stock at $53. Your cost basis ends up being 53 minus 84, or $53 minus 84 cents. So it's that's where this 52.16 comes from. And so yeah, if the stock goes way down, you can buy the put back. You can take ownership of the stock. One of the things that some people do is, you find a stock you like, you sell a put on it. You don't mind buying it at some discount to whatever price it was at when you sold the put, and then you can sell calls against it on the way back out, and just sort of keep that rolling along. And the way it's the same as a covered call is, right? So, right, you're into this position for 52.16 is your amount at risk. It finishes above 53, you keep 84 cents. And with a covered call, if you had a covered call with a 53 strike, anything above 53, you get the difference between your amount at risk and, you get basically the premium you sold, and then you own the stock at some discount to that on the downside. It's pretty much the same trade. The difference is sort of whether your liabilities are in cash or margin or in, a long position in the stock. Yeah, and then can the screener find the best out of the money covered call? So the screener is really looking at sort of optimizing the premium on a covered call per stock. So it won't find those long-term covered calls, but you can screen on hang on, let me start this over here. You can screen on what people call moneyness, which is sort of how far in or out of the money the the call is. So you can say, yeah, and so this is actually in the money here. So out of the money would be negative in the money. So if you want only things that are 2% out of the money, put a -2 in there. And then this column here, you can also just click it to sort. And so, yeah, we have some, I mean, these are, right, these are not the safest trades in terms of being highly rated stocks per the stock score report. And key rating, which is actually our evaluation of the trade, separate of our opinion on the stock, is also pretty low here because, yeah, you're not getting very much here, and the trade is real long. Right, these are January 2021. Some of these got the June 2020. So yeah, these aren't the most attractive trades necessarily, but you could probably put another cap in here somewhere, like I'll say, yeah. Oh, here we go. So yeah, these are a little bit more reasonable. They're not super far out of the money, again, because that's not really what we're doing here. But if you're looking for, if you're looking for those, relatively far out of the money trades, the best thing to do, because what you're doing is you're selling a call to try to generate income. You're not selling a call to try to have some sort of hedge position where you have some downside protection. The best thing to do there is probably find a stock you like and then use the out of the money tool to do that. All right, so yeah, can we talk about how the key ratings are determined? It varies by strategy. For, let's say, everything but vertical spreads, really what we're looking for is how defensible is the position. And by defensible, what I mean is, can you sort of play defense and manage it, right? So, something like this that gets a 2, my guess without looking is, yeah, so this is one relatively long in terms of being 52 days. That's toward the longer end of where our expirations are now. It also, this is probably a company that doesn't have dollar strike prices. So what we would like to have is something where we have a lot of choices in terms of the strike price. So if you had to roll the call or something like that, you're looking at a pretty granular, number of choices, right? So like a lot of stocks now have 50-cent strike prices. So you can really sort of dial in exactly where you want to be, right? Like that weekly option series plus 50-cent strike prices, right? You really have a lot of options in terms of rolling a call, and you can pick, almost exactly what it is you want in terms of, where you want to be in terms of strike and money. Whereas, some stocks that are more thinly traded, you'll see end up having, $5 strike widths, and they only have the monthly options. That makes it a lot harder to roll calls or do some of the other sort of defensive things that you would want to do in terms of managing those positions. And that the covered calls and the puts and the diagonal spreads all work basically on that principle. They're a little bit different because of how the strategy works, but that's generally what we're looking for, is sort of how much downside protection is there, how much downside protection is there at this strike and time to expiration in comparison to the strike widths. So like if you're selling a $5 an option for $5 and the strike widths are 50 cents, that, all other things being equal, will have a much higher key rating than if you're getting $1 on something that has $5 strike widths. Just because if you're only getting $1 and the strike widths are $5, it's real hard to roll that trade. You just kind of can't do it. And so that's how those work. And then for the vertical spreads, because we don't really do a lot of defense on those for reasons we've talked about in a bunch of these other ones, a bunch of other members-only workshops. Really what we're looking for there is the sort of risk-return ratio. Here, let's just pull one of these up. Yeah, right, so for every, because of the way vertical spreads work, right, every dollar you get in credit comes out of the amount you have at risk per per strike width. So at a $2.50 strike width like we have here, every dollar of credit comes off of your risk. And so that's one of the things we look at is sort of that ratio there, which is also just the return rate, right? Like here our return rate is 39%, which means that we're looking to make more than 2/3 of what we could possibly lose. And then the other things we look at are the probability of expiring worthless, which has to do with how far out of the money the trade is, and again time to expiration. So all things considered, across strategies, all things considered, a longer trade is going to have fewer keys than a shorter trade. And then, being further out of the money and, how safe we think the trade is really what the key ratings are about. And whether that's how safe it is in terms of the vertical spreads and the condors being kind of a one-shot deal, in terms of like, where do we think this is going to be? What are the chances that it ends for a profit? That's kind of where we are with the keys there. And then for the other ones where it's less of a one-shot deal, we're really more looking at, sort of how easy, how well are the options set up for you to manage the position. And so that's how the keys are sorted in that regard. All right, we'll see if any more questions come in. A reminder, this, like all of our workshops, is being recorded. We'll post the recording and send everybody an email to watch it probably early tomorrow, as well as posting a copy of the slides. And again, we'll be back in 3 weeks, which is, let's see here. November the 20th. So that's going to be the week before Thanksgiving. I think Thanksgiving is late this year. So November 20th, we'll be back for another one. Don't necessarily hold your questions until the workshop. We're happy to answer questions when you have them. You can send us an email, hit the help button on the website. This guy here. You just fill out the form and send it to us. We usually answer those pretty quickly. You can also call us. But especially the sort of more, I don't want to say esoteric, but questions that maybe are a little bit harder to answer in an email or over the phone. The questions we got today are all great questions and all questions that probably require a little bit more thought. And I'm certainly happy to put those on put those on slides. Talk you through how to use the website, all of those things. All right, well, I don't see more questions coming in, so I'm going to go ahead and sign off. Again, we'll send you a recording. It'll be up tomorrow, and then, I'll talk to you all in 3 weeks before that. And please don't hesitate to let us know if you're having trouble with the website. We just, it's a pretty major overhaul. We moved things around. We added a bunch of stuff. This is very much a situation where there are no dumb questions, so please, please don't feel shy about that. people have definitely reported problems to us, and we've been like, oh, hey, 6 or 8 or 10 or 15 or 20 other people were affected by this, and they didn't tell us. So yeah, if you have any sort of question or problem, please don't hesitate to let us know. Thank you all for coming, and I will talk to you soon.